They're going to limit withdrawals. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we're hearing news from the highest level of government that new rules and regulations are coming down the pipe for the banking industry as the government looks to take control of your money by limiting how you access it in the name of preventing bank runs. We're going to take a look at what some of these proposals are and how they're specifically designed to limit how you access your money. And we're hearing from a government agency that is taking credit for saving the economy from the banking crisis, is Al also mentioning that they may have actually had something to do with the crisis. We'll talk about how they're in complete denial of the absolute facts. And we're hearing some shocking news on how the consumers are reacting in the wake of the banking crisis. Let's over to CNBC, where we picked today's story up with a headline: bank stocks fall after top regulators back stricter regulations at high-profile Senate hearing on collapse of Silicon Valley Bank. And it was only a matter of time before Congress got involved, and they're going to look for someone to blame. And you can better believe that one of the people they're going to blame is depositors and their ability to quickly move their money. As you're about to see, they're going to put the brakes on that and limit how we access our money. Bank stocks turned negative today following a hearing before the Senate Banking Committee, spooked by top three regulators, each saying that they favored more stringent rules for banks with more than $100 billion in assets. And of course, this comes to no surprise. Anytime something major goes wrong in the economy, the financial system, or anywhere else, the only problem is we just needed more regulation and more rules, and that would prevent it. Of course, as we know, that isn't always the answer, but that is the answer when you're sitting on top in Congress. And at times the hearing was contentious as committee chair Senator Sherrod Brown accused regulators of having dropped the ball. Again, as a problem is with the regulators because they didn't see the ballooning risk that weakened Silicon Valley Bank before its ultimate collapse. But that wasn't the problem, as Michael Barr, the vice chair for supervision of the Federal Reserve, pushed back and said fundamentally the bank failed because its management failed to appropriately address clear interest rate risk and clear liquidity risk. And this I want to take a challenge with because, then there's this notion that the banks just had to do something different, that maybe other banks responded differently during the crisis and how they handled all these deposits, and that's why they're okay. But that isn't actually the case here. See, what regulators are missing is their simple answer is, well, they should have hedged rising interest rates. But I'm going to tell you, at the time, not only did the banks not realize it, absolutely nobody in the world thought interest rates were going to go up, and if they did, they didn't believe they were going up much. And here's the problems the bank faced. They got an influx of cash here in 2020 and 2021 through all of this government stimulus, and interest rates were relatively low, as we see here. This is the 10-year Treasury yield in red against the federal funds rate in blue. And at the time, again, nobody, not even the Fed, was talking about interest rates going higher. And sure enough, all of these banks had no choice but to lock in these deposits at super low interest rates because they had to back them with something. And then in response, the Fed goes on a crazy rapid hiking cycle. Of course, that drives yields higher. And of course, the answer is, well, it was just a problem with the banks. They didn't know better. But the issue with the banks is the rates were so low at the time, they really couldn't afford to hedge against a rising interest rate market because their margin on this money was already so razor thin to begin with. Had they tried to go out and hedge it, it would have wiped any potential profit or any interest to be paid to the depositors out completely. Again, one of the problems with a low interest rate policy. And Senator Elizabeth Warren pressed all three regulators about their views of stricter banking rules for mid-sized banks. Barr, Martin Gruenberg, chairman of the Federal Deposit Insurance Corporation, and Nellie Liang, undersecretary for domestic finance at the Treasury, all said they supported more banking rules. And without a surprise, what do you think regulators want more of? You've got it. More rules is exactly what they're asking for because it gives them a reason and purpose to have their job and their place in power. And it may be tempting to look at all this and say, we don't need new rules, that the real problem was these arrogant executives, Brown said, but there will always be arrogant executives. That's where we need strong rules. And perhaps as you've noticed here, there's no admittance that perhaps that all the stimulus that we did and dumped into the banking system was actually a bad idea. Perhaps driving interest rates perpetually lower as the Federal Reserve does is a bad idea. It puts us in situations where we have no margin for error, including in our ultra-clerical banking system, but nobody, as you'll notice, wants to admit any of that because they don't actually understand how the system works. We must evolve our understanding of banking in light of changing technologies and emerging risks, this according to Barr. And I want you to see here is how they're playing the blame game. This has nothing to do with any decisions they made in Congress or the Fed makes. This is everything to do with the problem is with the banks and the problem with depositors. And watch and see how this plays out here. As let's go back. And as he says, to that end, we are analyzing what recent events have taught us about banking. Now, notably, here's the key part. Customer behavior. And I want you to keep in mind, what was customer behavior in the social media? What did we see? Well, we saw a big hedge fund manager tell some of his feeder funds to get their money out of these banks. And then it went out publicly on social media and said, hey, I think people ought to get their money out of the bank. So no, I want you to see just how they're playing this out and why they think they need more regulation and how it's going to turn into limiting withdrawals. Because here you see concentrated and novel business models. Again, banks need to be more diversified. We need fewer banks. Rapid growth, deposit runs, interest rate risk, and other factors for how we think about financial stability. And the key one here is customer behavior, because if you go back and look at customer behavior in social media and then the mainstream media, nobody was the wiser until that hedge fund manager got out and said, hey, you need to pull your money. And because money can be rapidly moved now with our cell phones and other electronic devices, it means we can move from one bank to another bank and rapidly trigger a bank run. And if you don't think for a minute that policymakers at Congress and other government institutions are going to figure that the problem is really us and our ability to move money, and that if we couldn't move it, these bank runs wouldn't happen, well, I'll let you decide. Tell me what you think in the comments. Do you think I'm right? Do you think they're going to limit withdrawals and blame depositors? Or do you think they're going to take the blame themselves and say, no, it was really our fault? And here we can see kind of one of the problems inside the banking system is we don't have enough banks to begin with. And this is a case that you hear from regulators. Particularly, we heard this from Janet Yellen back when she was Fed chief, that she said it's easier to regulate fewer banks than more banks. And you know what? That's actually completely true. If you have fewer things to do in your job, it's easier than having a lot of things to do. But one of the problems with a fractional reserve banking system is you need a lot of banks because you need money to multiply through the system. So on this chart, unfortunately, it's now discontinued. This is new to me when I pulled the chart today, that the St. Louis Fed used to track the number of commercial banks, maybe because the numbers getting depressing, but we look at something called the money multiplier, which is the M2 money supply divided by the monetary base, and it shows how money is multiplied out through the system. When dollar is created, it has a multiplier effect. And you'll notice back in the 80s, it was up here around 11 to 12. Now it's down around 4. So money by the banking system is not being multiplied, but what you'll notice is it has something to do with the number of banks, which makes perfect sense. And so when you start to then consider this money multiplier effect and its ability to create inflation, you start to get the bigger picture here as you go back into the 80s, and we note in the 70s, which we don't have data for, in the 60s, there was a lot of banks. And so you could see money multiplied through the system as a deposit from one bank was moved to another bank and then lent out, and it became a multiplier effect that you get high inflation when money gets multiplied in the system. But as that goes away, as fewer banks lead the banking system a less ability to multiply money, you can't sustainably create inflation. And you look at these current levels, and we can already look ahead and say, look, the chances of the system being able to generate sustainable inflation here is not likely. We know a lot of it had to do with supply chain, and that's ultimately why inflation is coming down. And if you start putting on top of this the ability to limit depositors to get to their money, you're going to see even less ability for the banks to multiply money out, particularly if you see more regulations hitting these small and mid-sized banks that limit how their ability to lend money because they have to hold more money on deposit, hold more reserves. The less chance the economy has and the banking system has to multiply money and create prosperity. And now let's turn page, because we've got a government agency who again credits themselves for saving the banks to now saying that maybe, just maybe, but possibly not, they might have had something to do with the problem to begin with. And Fed's board says rate hikes are directed at inflation, not bank stress, because why would we look at bank stress? We're only the regulators of the banks. And he says, in my view, continued appropriate macroprudential, this was a new word to me today, policy can contain financial stress in the current environment, while appropriate monetary policy continue to put downward pressure on inflation. So what he's saying is, hey, we do create financial stress, and it just so happened there was financial stress. But you'll note, now watch how he changes this, and this is an essay he wrote. We'll look at the next paragraph here and watch how he changes his tune. And he says, financial stress has been on the rise since the wake of the recent bank failures and turmoil. The macroprudential policy response to these events has been swift and appropriate. So notably, hey, we might have had something to do with this, but look how quickly we've responded and fixed it. Regulatory authorities have used some of the tools that were developed or first utilized in response to the 2007-9 financial crisis in order to limit the damage to the macroeconomy, and they're ready to take additional action if necessary, because again, the Fed themselves doesn't actually get it. They don't understand it was them raising interest rates. It was them raising the overnight repo rate. It's them intervening in the money market space. It's all of these problems, them causing these unrealized gains or losses at the banks. They can't see it. Instead, they say, hey, don't worry, we fixed it, even though we might have had something to do with it. We totally got this one nailed. And something we also got nailed, I want to show you from our CTA-Timer Pro report. The other day I mentioned we gave a note out to our Pro subscribers. And what was that note? Well, crude oil, which was showing minus 100% short across the fast and slow algorithms, was flipping now, covering those short positions. And I told their subscribers, hey, what you're seeing here is a move higher, and what this should translate into is a move higher in the energy sector. Look at XLE, look at XOP, and sure enough, what you're seeing since we put that report out and told them, you're seeing this move higher. You saw the inventory reports today in oil and CTA-Timer Pro, $30 in the description below while supplies last, because I'm going to raise the price when you see how easy this tool is to use and make money. All right, now let's continue on, because the consumers are having a very interesting response to this banking crisis, one that most wouldn't have predicted. U.S. consumers are more hopeful about the outlook for the economy and jobs, which is shocking because these figures were captured in responses up to March 20, a little week after Silicon Valley Bank failed, suggesting the latest financial turmoil is having little immediate impact on consumer confidence, while high inflation and recession concerns remain front in mind for many Americans. Yet a strong job market and low unemployment continue to prop up sentiment, because in reality is sentiment here is all that matters. The labor market is all that matters. When your neighbor loses their job, it's a recession. When you lose your job, it's a depression. And if nobody really is losing their job, or not very many people, then everything's okay. And this is almost a shocking response. You think maybe going back to the savings and loan crisis, or even the global financial crisis, that any sort of boomers in the banking system would cause people to panic. But as long as they're not losing their job, they're not worried. And a special question in March asked about consumer spending plans over the next 6 months. Get this, they said they plan to spend less on highly discretionary categories, such as visiting amusement parks, which sounds great to me, and dining out, while they'll spend more on things like healthcare and auto repair. And for larger purchases, plans were mixed, as they plan to buy cars and TVs. But get this, the expectations to purchase appliances fell, and there's a good reason that went down. And it's simple, because we see pending home sales rebound slowing in February as mortgage rates reverse. Despite a big jump in existing home sales, pending home sales were expected to drop 3.1% in February after a huge 8.1% surge in January, in line with others that beat expectations, rising 0.8% month over month. And while this sounds good, it wasn't nearly as good as it looks. Here we can see on this chart here on a year-over-year rate of change, pending home sales remain negative at minus 21% year-over-year. No surprise due to higher interest rates. But look at this from the National Association of Realtors. This is the pending home sales report. And look at these numbers. You can see it is extremely low, back at levels that we saw near the bottom of the global financial crisis. And you can say what was causing all this problems? Well, a slowing economy for sure. Of course, the housing market, and experts are saying it's due to higher interest rates, but notably mortgage applications only up 2.9% this last week. If this number doesn't start to turn around, remember, housing is a key part of our economy. I think more layoffs are coming to that space, and we need to see housing turn around quickly. And with that, we need to see rates come down, and that will help the banks. But in the meantime, I think more regulation is coming down from the top, and that is not good. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.